It's like there's some good news. Oh, but it's really bad news if you're this type of person. Can you share exactly why the Fed news decision is or isn't a good thing?
Well, yeah, exactly, and it is. It's a good thing, bad thing. The Fed decision yesterday is a good thing. I think the way to think about it is in the long run, because the Fed funds rate, the change in the Fed funds rate going lower will eventually trickle out throughout the economy and have some beneficial effect. But it's going to depend on the type of, on the loan side, on the mortgage side, and on lending in general. It depends on what kind of loan products we're talking about. So, for first mortgages, it had the Fed reduction of 1/4% certainly was not unwelcome, but the expectation that that's going to trickle to a 30-year mortgage going down by the same 1/4% in the short term or almost immediately simply is technically not how it works. And so the consumer over and over again gets disappointed when they hear about the Fed funds rate reduction from the news media, and then talk to somebody like us and we say, well, guess what? Rates are worse after the announcement, not better. And again, the underlying issue there is the bond market focuses not so much on the Fed funds rate, but on inflation data and labor market data. And the Fed commentary underscored the fact that they see a pretty strong economy. They do acknowledge the labor markets, had a little bit of an issue, but not in a substantial way. In fact, layoffs are down quite a bit. So the concern in the bond market is that the combination of inflation not getting closer to the 2% target, it's actually creeped up a little bit the last few months. Plus the fact that the Fed's now saying, well, we're going to slow down on lowering the Fed funds rate aggressively. That is not good news for the bond market, which is what's causing those yields to creep up, and therefore mortgage rates, long-term mortgage rates, going up as well. On the other hand, this is good news for other types of lending. Short-term loans, credit card rates could improve a little bit because of this. And where I think is a bright spot in the mortgage industry is equity loans. Equity loans are generally shorter term loans, both the fixed rate variety, most of them that we do are 15 to 20-year term. And then, of course, HELOCs. A HELOC is tied to the prime rate, which is directly correlated to the Fed funds rate. So if you have a HELOC, you've enjoyed or will enjoy a 1% reduction in your rate just since September. And if you're contemplating a HELOC, getting one now is still probably a good idea because the rate is lower than it was 3 months ago. And with the Feds now forecasting maybe 2 reductions next year instead of 4, that's still going to be somewhat beneficial for a HELOC. So again, good news, bad news. Long-term mortgages, the rate cut eventually will be good news. Short-term, the commentary about that rate cut, not so good news, but this will help equity loans in a much bigger way than it does long-term mortgages.